Without further ado, I would like to introduce Sheyantha Abeykoon, Group CEO of Boost, the regional full-spectrum fintech arm of Axiata Group. Please put your hands together for Sheyantha on the role of fintech in paving the way towards financial inclusion.
Okay, good afternoon. Can all of you guys hear me? Okay, not loud enough. Can all of you guys hear me? Okay, so I hope you guys had a good session in the morning. My session is slotted for 45 minutes, and Axiata, my parent company, always throws me challenges, and I think this is another one to get everyone excited after lunch, right? And also hopefully to get more people back into the room. But not to worry, we have, I think I'm told straight after me, a very exciting session on cybersecurity. Always has me at the edge of my seat when I think of cybersecurity. And we've got a fantastic speaker in Abid and his team next. So it's okay if you guys have a nap during this session, but just make sure that you guys are all fresh for the wonderful cybersecurity session straight after me, right? Okay, Abid, good enough intro to you? Okay. All right. So for those of you who don't know me, my name is Sheyantha. I run basically the fintech business in Axiata, broadly known as Boost. I think a lot of you, I think all of you here are from Malaysia, so most of you would know Boost as an e-wallet. Actually, Boost is a lot more than an e-wallet. We started our journey as an e-wallet. And the topic I've been asked to speak about today is the role of fintech in paving the way for financial inclusion, which is a bit of a heavy topic, honestly, after lunch, right? And what I'll try and do is I will run through a little bit of our journey, which is about 5 years across different fintech verticals, wallets, lending, about to launch a digital bank, all that. But I'll try and give you a perspective of where I see the industry growing and the industry, how fintechs as a relatively new animal, how fintechs can actually help solve the financial equation problem, or the financial inclusion problem rather, in a Malaysian context. So I'll try and leave you with a few ideas and thoughts. But other than that, like I said, if anybody wants to take a nap now, please go ahead and just make sure you're ready for Abid. I do have one request though. It's okay if you sleep, but just make sure you smile. I find it very disconcerting if somebody's not smiling. If they're sleeping, it's okay. But if you're sleeping without a smile, I'll just make sure the person next to you nudges you so that you at least have a smile on your face, yeah? Okay. All right, let's get started. So, sorry, heavy slides. But basically, if you take the animal of a fintech, what is a fintech company, right? So fintechs really came about in the 2010s, the last decade or so. Before that, you really didn't have this technology company, which we today broadly classify as fintech, digital financial services, and all of that, right? And the reason for this business to come about was multifold, right? But broadly in our markets, Southeast Asian markets, even South Asian markets, the primary reason for them to exist, or the supposed reason for them to exist, was there was a market gap. There was a market failure in the sense where traditional FIs didn't meet were not able to service society at large, businesses at large. So thereby, there was a gap in financial inclusion. If you look at this pyramid behind me, this is kind of, I think, aggregate data for Southeast Asia, going back about a year. But generally speaking, and this varies from country to country, and if you look at this either from a consumer perspective or from a small business perspective, it's broadly the same. But there's a large swath of, obviously, customers at the bottom of the pyramid that are not served by financial institutions. Then there's also what is quite interesting in a Malaysian context, because a lot of people tell me Malaysia has, 85, 95, depending on the stats you look at, banking penetration, right? Why do you need more digital banks? Why do you need fintech players? We are fairly well banked. There's a large segment across a lot of Southeast Asia that is nominally banked, right? But is really not penetrated in terms of adoption of financial services. And Malaysia, I would argue, I mean, having been and worked in this sector in Malaysia for almost 7+ years, I would argue that Malaysia fits into that category, right? Where there is a fair amount of white spaces, or the fair amount of unsolved segments of business and society where the penetration of financial products is not where it should be. Now, obviously, I've come some examples on the right, and like I said, all these different business models came about in the last 10 to 15 years. They did not exist before that. Some of them have become very large. So if you take Nubank in Brazil, grown exponentially post-COVID, and really one of the largest banks in the country now, really solved the financial inclusion problem. You take bKash in Bangladesh, right? Very large payment service provider. You have GCash in the Philippines, again, another fintech that has a telco heritage, again, grown very rapidly. So some of these businesses have scaled very rapidly in the last couple of years. And I think the fundamental difference in fintech versus other technology or digital companies is this. You are operating in a highly regulated sector versus, let's say, e-commerce or digital advertising or AI analytics. Fintechs operate in regulated sectors, usually highly regulated sectors, the further up or more complex your business model is. And the second thing is, it's a very local business, right? Because if you're doing financial services in a particular market, it is very different and it's not something that you can have a single business model across markets. There are local nuances that you need to adapt to. Boost, for example, we operate in Malaysia, but we also operate in Indonesia. A lot of people tend to think underserved sector, small businesses, very similar, very different in how we operate in both markets. Not just because the licensing regime is different, but because the local nuances, the way in which business is done, the way in which business is regulated is very different. Okay. So if you look at this from a Malaysian context, and this is broad brush kind of stats here, basic savings, what I spoke about, banking penetration, relatively high, right? Financing, whether it's a micro SME or a consumer, generally a 1/3 penetration there. Insurance penetration, almost 50%, I believe. That should be a financial literacy. Sorry, it's not basic. Financial literacy, generally below maybe the high 30s, mid 40s, depending on the stats you look at. Investments generally low, right? But I think there have been a lot of initiatives, both from, government agencies. I know there's a lot of people here from the government sector as well, and also from the regulator to try and bring financial inclusion into most of the mainstream policy agendas we've seen, whether it's the Madan economy, whether it's the financial inclusion framework that Bank Negara published. The role of the need to be inclusive in financial services is there, right? If you read through the details. Now, what has also happened is it's good to put stuff in policies, but also there has been licensing frameworks that have come out that have been in support of those policies. So for example, one is the digital bank licensing framework that came out from Bank Negara, and they also have a digital insurance framework that has been put out, right? So it is well and good to talk about policy, but it takes a lot more to actually put out frameworks that enable people thereby to then adopt and build business models on. So I think from that perspective, we've done quite well in Malaysia. Financial literacy, agent banking, a lot of focus there as well. Two areas that I think the regulator is talking about quite a lot, not quite a lot, but should be talking about quite a lot, and is an area that is growing in the area of not just fintech, but in banking and finance. One is open banking, right? The other one is embedded finance. By the way, how many of you here have heard of open banking, know what open banking is, just for me to get an idea? No? Okay. Embedded finance, anybody who has heard the concept, understand? Okay, fine. Let me talk a bit through some of that, yeah? Okay, so again in Malaysia, right, we've had We're not a very large fintech hub, but we've had a fairly large number of fintechs that have grown in the last 5 to 6 years in Malaysia. So if I think about this, you got different business models. You got investment robo-advisory companies, digital wallets, payments, somewhere we started as well. Insurtech companies, microfinancing companies, and digital banks that have also been in vogue and been in the news a lot, right? Just about to launch. We also have a lot of companies that are enablers, that enable the service providers. So you have credit scoring companies, you have RegTech service providers, you have a whole host of, and I've met some of them here, whole host of cloud-hosted banking solution providers, whether they are core banking systems, whether they are eKYC systems. So people who build the infrastructure around it. And you have B2B platforms that provide fintechs the opportunity to provide market access. Very important. So the good news is, I think in Malaysia, you have all these players in some form or the other that are relatively active, right? I think there is more penetration in certain areas like, let's say, wallets, microfinancing, more so than others. Those tend to be, even if you look at our journey, I think that's where we focus a lot on, building scale through payments and then making money through lending. That's quite typical. But you're having a lot of other service providers also broadly building up. Now, what happens? I mean, if the end objective is financial inclusion, two things have to happen for financial inclusion to have, and then it's two sides of the same coin. You need to increase the level of financial literacy. Because a lot of the people a lot of the businesses that today do not adopt financial services are not financially literate in the truest sense. So how do you engage in responsible financing to grow your business? As an example, right? Could be one, right? One topic that comes up. How do you think about insurance in a way that makes sense for a small business? Very different from the insurance you and I buy. At the same time, digital adoption. So a lot of the people, a lot of the small businesses that need financial services are businesses which by nature are not very digitally literate, right? So in many cases, you try and tell somebody, I'm going to solve your problem. You can't get financing from a bank. I'm going to give it to you on a digital platform. They'll be like, great. Problem is, I don't know how to use a digital platform, right? So you give a problem, you try and give a solution with another problem, right? So that's why, for me, if you really want to solve inclusion, right, it's got to be an investment and focus on improving financial literacy as well as digital adoption. People tend to talk about one or the other, but really both go in tandem. And especially if you want to serve the bottom sector that I spoke about, you need to do both, right? And education is not, education in the form we're used to, like tutorials, FAQs. It's actually education by doing. The best way for people to actually learn how to use digital platforms is not to read an FAQ, is to actually use it. So how do we, so one of the things I'll talk about is, you need to bring down entry barriers to people. You need to bring down the risk threshold. So somebody can use your platform without much risk. Somebody can use your platform with, it's a no regret. When you bring down those thresholds, that's when people adopt. And that is also, by adopting, you learn. Right, and that's the only way you can solve adoption and financial literacy. It's really by doing it. And it's by making sure that whatever products you build meet that objective. All right? So I think that's quite important. Okay, and before I talk about Boost, I thought I'll just take a case. I mean, we're talking about different fintech companies here, but this is one company that I like. Policy Street. How many of you have used Policy Street here? So Policy Street is an insurance marketplace in Malaysia. Started very ground up, founder driven. Didn't have the luxury that Boost had of having a big parent with deep pockets, right? It was just a founder driven company. And somebody that develops a pure play insurance product is something that I actually quite like. because we also have insurance in our portfolio. But it's actually one of the most difficult financial products to get out to the market on a digital platform. I mean, how many of you get up in the morning and say, I'm going to buy an insurance policy? Certainly I don't. Maybe cybersecurity policy, yes, a bit, but not an insurance policy, or not other than my car insurance. You don't, right? I certainly don't. But that is, so for that reason, if you take the insurance sector, a lot of it is agent-driven, personal selling, right? Now, what these guys have tried to do, and there are a couple of guys in the insurance sector, they've tried to take that personal selling onto a digital platform, and they've been quite successful at it. So I take this as an example because I quite admire people who have the guts to do something like this, which is not an easy sector to be in. But what is the inclusion problem they have solved, right? They have been able to solve both for general and life insurance. I'm not sure whether they have life, but certainly general insurance. They've been able to bring down the cost, right, of not just the premiums, but the cost of adoption, because they've taken out the agency layer, right? And they've been able to transfer that benefit over, right, to people. They've also made, if you've used this platform to buy insurance, it's relatively seamless, it's relatively easy. No regrets in using it. Thereby you bring down the barriers for usage, right? And recently they got funding, did a successful funding round. So this is while we have digital banks out there, while we have a large number of wallets out there, there are pockets of people out there who actually do build very, very successful models with starting from very humble beginnings. So I think that's the fact that you're getting more and more of these companies out in Malaysia is quite positive. All right, quite positive, because it shows that entrepreneurs are willing to take risk, people are willing to adopt these services, right? And there is capital, they raise funding. There is capital where investors are willing to put equity risk behind these models, right? So this is just an example. I thought before I didn't want to make this an advertorial for Boost, so I wanted to share a few examples of what's happening out there as well. Okay, if you take our journey, I'll skip through this slide very quickly. We started off in payments, built a fairly large payment platform, but we really focused from day one on the inclusive agenda, which is what I want to talk about. And we built a lending business. We scaled quite nicely. I think in 2020, we got an outside investor in Great Eastern Holdings, was the largest fintech deal in Malaysia at the time. And if you've been following the news, we were one of the 5 recipients of the digital bank license, and touch wood, about to launch this before the end of the year, hopefully. But let me start with kind of the origins, right? If you really, when we got into payments, right, it was not an obvious decision at the time. I remember we went in front of the Axiata board at the time, and we were really challenged. Malaysia is a fairly well-banked market. You generally have payment acceptance points, credit card penetration. You're a lot of third-party acquirers. You don't need, is cash really that used? What's the problem you're trying to solve, right? And that was really a fair question, and it really challenged us at the time. So we had to go back to the drawing boards when we started, and we decided if we are going to get into payments, we want to start by disrupting cash, right? And where is cash usage the highest? It's really in the small merchants, right? So, your nasi kanda outlets, even non-permanent establishments, pasamalams, etc. That is the problem we went out to solve, right? And that was not an obvious choice at the time. This is 2017. That was also quite difficult, because it's very difficult to get those guys to put on a QR. Now you see QRs everywhere. That was not the case in 2017. But we decided that was the only problem as a payment service provider you would be solving, right? Being able to digitize cash payments. And we needed to really go to where cash was used the most, and also educate people on the cost of using cash, right? So that was really our story. And because we focused on that segment, that's why payments took off for us in the early years. If we had stayed on the top of the pyramid, I wouldn't probably be standing here today. There would be no Boost. The adoption actually happened in that segment. If you look at most of our transactions in 2018-19, it was people using it on merchants that were really at the bottom, right? It was not somebody using it at a Starbucks. It was not somebody using it at a McDonald's, right? That's what helped us take off in our payment services. So then that gave us legs and a customer base, because we had an inclusive agenda. We wanted to focus on where the problem was. We were able to build scale. So what we decided to do was we decided to do lending on top of that. In payments, nobody makes money, right? But we decided to focus on lending. At that time, a different brand. We had something called Aspirasi, which is today Boost Credit. We were going through a bit of an identity crisis. We consolidated all our brands subsequently. But here again, we wanted to solve a problem, learning from our payment experience. If we had started doing QRs for McDonald's and Starbucks, we wouldn't exist, right? So again, when we thought about lending, who were we going to lend to? And we decided we wanted to lend to the same small businesses. We wanted to lend to micro SMEs, right? Because that's where the problem was. Those were the guys who couldn't get financing. And we decided to do it in a very novel way. We will score you on your transaction data or whatever we can get our hands on. You don't have to give us your financial statements. You don't need to give us your income documents. And there was a learning through this, right? But we wanted to take the friction out of the process, get somebody who couldn't go to a bank today and get a loan, give them a loan, but also score them in a way that we had a high degree of confidence they would be able to pay us back, right? Now, fast forward about 4 years, I think we've done about 3 billion ringgit worth of loan disbursements. Overall, over the cycle, our delinquency must be around 4%, right? So generally good in a high sector. And I mean, the statistic that I'm quite proud about there, and that's something that even helped us during our digital bank license, 50% of the people we have lent to are what we call new to credit customers. So what that means is these are guys who never had taken a loan in their life, right? So people talk about financial inclusion, right? But I think it's really important to see whether you are actually doing it, right? So 50% of the people who've taken loans from us did not take a loan in. They had never taken a loan before, right? And that shows that you are actually then servicing the segments that you set out to service. So it's actually something we look at quite a lot. And to be fair, there's a lot of people who have now come into this space and have done the same thing, right? And there are a lot of customers who've taken loans from us, developed a credit profile, and have been able to go to banks or have been able to go to our other fintechs, right? So we've been able to include them into the financial economy, people outside. And that, I think, is really what inclusive growth is about, right? Got an example of something we did in COVID as well. Again, we did this in partnership with actually the Ministry of Finance, a program called Aspirasi Assist, where we gave, during the COVID period, a lot of businesses were shut down. We gave financing schemes. Again, worked well because we were on a digital platform. So obviously, when everyone is in lockdown, this is a loan you could apply basically on your laptop or on your phone, right? Something that, again, worked quite well. Okay, I'll skip through this slide in the interest of time. So, okay, I'll talk a little bit about embedded finance. So, like I said, there are many things I'll talk about here, but two things I think that are quite useful and two things that I think when I reflect on my experience doing this business, two things that I learned as well. One is, I'll take this example of embedded finance. So what I've learned, especially, I've been in digital for almost a decade, it's very difficult to get a customer who is new to digital or new to your service to actually adopt your service. Why? Because you're asking them to change their behavior. They need to download an app, they need to register, they need to put their IC, they need to take a picture. You know, you're creating a lot of steps. So the concept of embedded finance became very popular in the last 2 years. We have actually been doing embedded finance, and a couple of other fintechs, not just in Malaysia, in Southeast Asia, have been doing embedded finance for a while. And the simple concept of embedded finance is I embed my financial product into what you do in your daily work or in your normal customer journeys, right? So, for example, buy now, pay later. I mean, it's something that has been plagiarized a bit, but that's an example, a very simple example of embedded finance. You are buying something that you would buy a coffee, you would buy whatever you would buy on a day-to-day basis, but you're actually taking a personal loan with that. But that is embedded into your daily transaction. You don't need to do anything different, right? So we have taken this concept of embedded finance even to the micro SME sector. Have I disclosed the name here? I haven't. So we work, let's say, with small retail outlets. So there's one retail outlet that we work with. I'll just take one retail chain that buys dairy products, milk. Now, what this retailer does is they have a system that they get from their distributor. They place an order every day for milk cartons. The retailer will place an order based on how much cash he has because he has to pay the distributor. So he has 50,000 ringgit that day, place an order for 50,000 ringgit. He'll order it on his system. Been doing this for the last 5 years. Now, if he doesn't, if he has demand for more than 50,000 ringgit, he doesn't have the cash to pay. So it's an opportunity missed. So what did we do? We actually scored this retailer or this set of retailers on the same system that he orders every day. We just put an extra toggle, said, you can order for cash. You guys can see this toggle. Here, we just inserted this little toggle onto the same screen the guy sees every day. You can order for cash or credit. Now, if the guy is out of cash, they get a credit line for us and they can order from credit via the credit line. He doesn't need to do anything different. He just needs to just move this toggle. So what we did is we embedded essentially a loan into what this retailer does every single day, right? And the usage there of that was almost 90%, right? Because the guy didn't have to do anything different from what he was doing. We inserted ourselves into the journey of a customer as opposed to asking the customer to do a new journey to adopt our service, right? And that's the real power of embedded finance. And if it happens at scale, it's very, very powerful. Where a lot of people, including traditional banks, when they digitize, they make the mistake of asking the customer to come and adopt your services on new platforms, change your behavior, go through a new series of steps, sometimes avoidable like eKYC. But that's where the friction happens, right? So the concept of embedded finance as digital banks, I'll skip through this as well in the interest of time, is something that is coming in vogue and is very, very powerful. And in Malaysia, you will see more and more of this in the next couple of years. The other concept I'd like to leave you guys with perhaps is, again, something that the regulator, Bank Negara, I think is looking at, is something called open banking, open finance, open data, right? This is also something that I have been a big proponent of that is happening. So what this means is banks have a lot of customer data, bank statements, etc. Finance companies or other financial institutions have a lot of data, insurance companies, leasing companies, a lot of data. Other companies like, for example, telcos like, Axiata or any other telco have a lot of customer data. Right now, the purpose, the true principle of open banking, open data, open finance is how do you democratize that data? How do you create platforms in which that data can be opened up to third-party service providers, like fintech companies, like any other technology company, right? Now, what's the usual response? If you talk to one of the large banks or you talk to any of the large, I'm not going to give my data to anybody. That's my data. I have a fundamental problem with that statement. It's not their data. The data belongs to the customer. It's the customer's data, and we should never forget that, right? And it's up to the customer to choose how the customer gives rights for people or service providers to use that data, right? So this is something that's taken off in Europe actually quite a lot in mainstream Europe, even in the UK, not so much in the US. And it's getting increasing, I think, policy focus in our markets, right? And it's something that I am actually quite passionate about, because even from my perspective, I work for a large telco. We are about to launch a bank. I worked in a fintech. I've seen all sides of this model. And I think it can be very powerful. Let's say if you are an individual customer and you choose, nobody else chooses, you choose if you want to give rights for third-party service providers to use your data. It can be very, very useful in terms of getting targeted financial products that I need. Very often, there are financial products that I'm sure all of us are bombarded with at certain points in time that are not relevant for any of us, right? There are financial products that are provided not at the point of use when I need them. I was just talking to our chairman, Tan Sri Sharil, and he was telling me one very good use case for the use of financial products is very often people go for their medical bills, uninsured. And they suddenly realize they have to do a procedure and they're out of, there's a financing gap at that point in time. Imagine somebody being able to offer you something at that point in time, right? So being able to offer a financial product at the time of use, at the point of use, that is very relevant for you. That's what everyone in this business is after. And that's what something like this would enable you to do, right? So I understand that even in Malaysia, it's something that Bank Negara is looking at quite openly. And obviously there are safeguards and guardrails that have to be put in place, because we're talking about customer data, but it's absolutely with the consent, the explicit consent of the customer, right? But I think that is, if you really want to get and break the next frontier in financial inclusion, this needs to happen. This needs to happen. Okay, how much more time do I have? 5? Okay. So maybe I'll rush through this. I'll talk about banking. I get a lot of questions, obviously, on digital banking. So one question that people ask me is, in Malaysia, we are fairly heavily banked. And what is the case for 5 new digital banks, right? I would argue this way, right? I would argue that if digital banks are going to do the same thing conventional banks do on a digital platform, there is no case for digital banks to exist, right? So if you look at the digital banks that have been successful globally, most of them have been banks that have been able to embed themselves into ecosystems. I have WeChat Pay and WeBank, MyBank, the 2 Chinese examples which are well known. But if you take most examples of, I think there are close to about 24 profitable digital banks now. Most of them are banks that have been able to embed themselves into other ecosystems, banking as a service models, doing things very differently than just digitizing a customer interface. Those are the models that have been successful, right? And if you look at the people who got the digital bank licenses in Malaysia, I think that's all of them have digital ecosystems, right? And I think that is something that I can't speak for the others, but I think that's what you'll see a lot of the digital banks in Malaysia doing, banking on their existing ecosystems, right? So a lot of people ask me, what are you going to expect when the banks? I think that's generally speaking what I would expect. I would expect a lot of people to bank their base using their existing platforms, right? So let's see. We'll know in 12 months from now, but that would be my hypothesis. So with that, maybe I have a few more slides, but I think I'm out of time. Maybe I'll spend 5 minutes more for Q&A. Any questions anybody has?
Hi, Sheyantha. I'm Aiman from Khazanah. So
Hi, Aiman.
A couple of questions. Firstly is on the open banking, which you just talked about. I was wondering what's the incentive for traditional banks to open up their customer data to fintechs, right? I mean, other than probably regulatory pressure, is there actual financial incentive for them? And secondly, if you could just share a bit more about Boost's transition from payments to financing, right? How did it look like in the beginning? What was the NPL, the evolution of the NPL, and what did you guys do to sort of tackle that? I'm sure it was higher in the beginning, right?
Okay, first, great questions. The first one, you're right. So if you look at open banking, there are two models. One is a market-driven model where you tell everybody go out, sign up your own deals, so bank to fintech, bank to somebody else, or a regulatory-driven model. Like, so Europe had PSD2, in the UK they have another standard coming. It's the regulatory-driven model that has worked, honestly. And that is there because of this asymmetry. So large bank to small technology company, I have no incentive to give you my data, right? So the short answer to your, that is exactly why it hasn't taken off, right? So there has to be some kind of a regulatory intervention to make it work, right? So that's one. Of course, you can do bilaterals between, like I took an example of a telco and a bank, which can be quite powerful, right? But for various reasons, maybe organizational friction, etc., that also hasn't worked, right? So generally speaking, if you have large company that has data, small technology company, because of the asymmetry, it doesn't really work, right? So that's the problem. So usually there has to be some kind of regulatory intervention. So in the US, they go on a market-driven model. You guys sign your own deals. It hasn't worked. Europe, it has worked because of PSD2, right? So that's the first one. The second one on our experience, yeah. So I mentioned our NPLs have been, broadly speaking, below 4%. They've been as low as 2% over 4.5 years. Our evolution into lending was quite early. So we were just a pure payment service provider. We started lending in 2018. So we were just a pure payment service provider, just perhaps 1.5 years. And that was always part of the plan, because we knew very early on that you couldn't make money in payments, but payments was kind of a captive ploy to get a mass of customers, and then you get transaction data and other types of data that allows you to be able to lend to customers on the same platform, which is relatively frictionless. Right now, was that a linear journey? No, it was not. Right, there was a lot of learnings along the way, but broadly speaking, we were quite successful. But one of the things we did, I think, which was quite useful for us, we didn't say you had to be a Boost customer to get a loan from me. You didn't have to come onto my platform. That was something that we debated heavily. So we integrate into anybody's platform. So for example, we were with Lazada. We were the largest, probably in 2018-19, we had a program with Lazada. We had integrated our financing into the Lazada seller platform, and we were the largest financier of sellers on Lazada. They didn't have to be even a Boost merchant or a customer. So we went down that agnostic model, and that helped us to scale our lending quite aggressively. A lot of people try and keep it within the family, within the ecosystem closed loop model. We didn't do that. And I think that in retrospect, that was one of the best decisions we made, right? So that helped us to leapfrog a little bit in how we grew our lending business. And it also, in retrospect, it helped us to scale much faster than we would have had we just kept it within our ecosystem. Does that answer your question?
Yes, good afternoon. My name is Joseph.
Good afternoon.
The question which I wish to pose is, what is the strength of the non-owned digital banks, non-bank-owned digital banks in Malaysia? I think there are 5 entities that have been given licenses, and 1 or 2 of them are non-bank owned. What is their strength? Thank you.
Actually, I would argue that all of them are non-bank owned in the sense, one is owned by an investment bank, and we have RHB in our consortium. They have 40%, but generally speaking, majority are non-bank owned. Now, you don't necessarily need to have a bank to get digital banking right. I think that's the first presumption. Even for us, right? We have RHB as a partner in our consortium, but RHB is providing expertise in certain areas, but they are a minority shareholder that is allowing it to be run as a digital first company, right? I think if you take all the players out there, I can't speak for the others, but they are technology companies that have got a banking license. So fundamentally, I think even if you look at the regulator, The idea was not to give an existing bank another license, because you could argue and say an existing bank can do it anyway under the existing license, right? The idea was to give technology players, non-bank players, and bring them into the fold so you get new business models working. To some extent, challenge the existing models. So if I gave an existing bank another digital bank license, I would probably get the same thing in a different form. So I think the idea, again, I can't speak for what the regulator thought about it, but the idea was to bring some of these technology players who had gained scale and were doing financial service products as a technology-first company, bring them into banking. So I actually don't think you need to be a bank to succeed as a digital bank. You need to have banking knowledge, and yes, obviously, a lot of people have hired ex-bankers into those banks. But I think if you're not a technology-first company, that defeats the purpose of actually trying to be a successful digital bank, because you're starting from the point of view that you have a disruptive business model and technology. You're not starting from the point of view that I'm a bank. Most of the banks have their own apps. They will digitize. They will continue that journey. But I think the regulators were looking for something different, and that's why they went down this path. So I actually feel you don't need to be a bank at all.
Hi, Ashraf from Exim Bank. This suggested to my previous employer, a development financial institution, to try to do some microfinancing startup, but because of the mandate, maybe they were not interested. But you started do microfinancing in 2018, right? So the reason why I suggested in 2017 was I observed some companies, startup companies like Grab were acquiring microfinance startup in 2017, 16, 18. So unfortunately, my boss was not interested. Okay, so my question is, with like Boost collaborating with RHB Bank for the digital bank license, what do you see Malaysia's DFI, Development Financial Institution, role to support the inclusion for those who are unserved and underserved Malaysians? I mean, there are a few DFIs, but there's now digital banks. Is there any like conflict of interest? Is there any competition or potential collaboration? Because normally we see from commercial banks who are more into the inclusive. Hello? Okay, inclusivity of digital financing, but DFIs not so much. That's just my view. Want to hear from yours.
Thank you for that question. So DFIs, I mean, traditionally, not just in Malaysia, DFIs came about with a development mandate slightly different to commercial banks, right? And I think when they started, it was driven by a lot of grants coming through, even the agencies, right, for development financing. So it was project financing, development financing. Now, I haven't followed the DFI evolution 100% here, but still the DFIs, I think, have a very strong development mandate. If I look at the sectors that the fintechs, you mentioned Grab and a few companies, even us, target, they're probably a tier lower than what the DFIs go for in Malaysia, right? So both in terms of ticket size and the stage of the business that somebody is in. So usually somebody below a 12-month, if you're not in business for more than 12 months, you probably can't get a loan from a DFI. You also below 500,000 ringgit, you can, but nominally, but then there are challenges, right? So I think the segments the digital banks would go after maybe slightly a tier lower, right, than the DFIs. Now, can the digital banks work with the DFIs? Can they partner the DFIs? I think, I mean, I can't speak for everybody, but certainly I think if you look at the digital banks, during the foundation period, there's an asset cap of 3 billion ringgit. So you can't go beyond a certain level. You can't scale your own balance sheet beyond a certain point. So there is potential to work with other banks or financial institutions who would want to partner, let's say, a company that's digital first, like a digital bank, and leverage their balance sheet on a digital bank's platform. I can perhaps see that happening. The challenge has been traditionally the underwriting standards or the way people underwrite in a traditional FI is very different to a digital company. So that friction has been the biggest bottleneck, not that people don't want to partner, right? So when you still have physical underwriting, income documentation, and a fairly long, rigorous process, it takes time to change that. I think that has been the biggest problem, not so much the willingness to partner, right? And I myself have spoken to many DFIs over the last 4 or 5 years. I think there's always been a willingness to partner, but it's been more the internal kind of way they are set up. That's kind of been different. But I think going forward, that's potentially a way. Even though digital banks can technically have their own balance sheet, they do have an asset cap in the first 3 years. So if somebody wants to go beyond that, they can obviously partner somebody for balance sheet support. Yeah.
We have time for one last question. Do we have one last question from the audience?
No question? All right. Thank you very much, guys. Thank you.
Thank you, Sheyantha, for showing us the vital role of fintech in spearheading financial inclusion.